Right now, as we speak, BigBear.ai, BBAI, is trading live at $6.17, currently down about 1.59% on the intraday charts. The market is open, the tickers are flashing, and if you are looking at the red ink on your screen, your first instinct might be to flinch. We are seeing a classic consolidation move, a pullback that seems to confirm the skepticism many of you feel when you look at a small-cap AI stock that has already rallied hard. The volume is ticking over, currently sitting at roughly 169,000 shares traded so far today, and the price is oscillating between a low of 5.50 and a high of 6.28. It feels heavy. It feels like the momentum is fading, like the air is being let out of the balloon after the recent excitement. But here is where you need to pause and look closer. This is exactly what the smart money wants you to see. The expectation right now, the narrative being pushed by the bears and the headline skimmers, is that BigBear.ai is just another hype-fueled AI penny stock running on fumes, destined to crash back down to the $2 range as the excitement wears off. They see a company that is not yet profitable on an operating basis, they see a price-to-sales ratio that has expanded, and they assume this recent dip is the beginning of the end. That is the expectation. The reality is something far more interesting, and frankly, far more explosive. What looks like a sell-off on the daily chart is actually a technical backtest of a massive breakout level coinciding with a fundamental transformation in the company's business model that the broader market has not yet fully priced in. While retail investors are selling the red tick, institutional giants are quietly positioning themselves for what comes next. We aren't just looking at a stock that moves with the wind, we are looking at a company that is fundamentally changing how the U.S. military and international governments process intelligence. The dip you see at 617 isn't a breakdown, it's a bear trap. Let's strip away the noise and look at what is actually happening under the hood of BigBear.ai. To understand why this price point is critical, you have to understand the magnitude of the news that has been dropping lately. Most people saw the headline about the Q3 earnings beat or the Malaysia deal and moved on. They didn't connect the dots. The expectation was that BigBear would struggle with the lumpiness of government contracts. The reality delivered in Q3 was a revenue beat of $33.1 million versus expectations of $31.8 million. But the real story wasn't the top line. It was the strategic pivot represented by the Ask Sage acquisition. For years, the knock on BigBear.ai, and honestly, on many defense contractors, was that they were essentially services companies. You hire people, you bill for their time, and your margins are capped. It's a steady business, but it's not a scalable software business like NVIDIA stock or Microsoft. Investors want software margins, not service margins. The acquisition of Ask Sage changes the calculus entirely. Ask Sage isn't just another consulting arm. It is a generative AI platform specifically certified for secure government environments. This creates a recurring revenue stream, a software-as-a-service layer that sits on top of their existing contracts. When you see the stock trading at $6.17, the market is pricing it like a service company. It hasn't yet repriced it as a SaaS platform with high margin potential. That gap between the current price and the future valuation is where the opportunity lies. And it's not just about software. It's about where that software is being deployed. We need to talk about the Pahang Aerospace City deal in Malaysia. This was a memorandum of understanding signed just days ago, and it flew under the radar for many who stick to domestic headlines. This isn't just a contract, it's a geopolitical foothold in the geopolitical space. Malaysia is a critical strategic partner in Southeast Asia. By installing BigBear.ai's concept of operations technology into the region's first AI-driven aerospace hub, BigBear is effectively planting a U.S. flag in a region where Chinese tech influence is heavily contested. This validates the technology on an international stage. The expectation was that Big Bear was just a U.S. Army-centric niche player. The reality is that they are becoming a global export of American defense-grade AI. Let's zoom in on the price action we are seeing today. The stock is hovering around $6.17. Technically, this is a battleground. We saw a massive run-up recently, touching highs near $6.30 to $6.40, and now we are seeing the retracement. Traders who use interactive brokers or thinkorswim are likely watching the volume-weighted average price very closely. The stock is trying to find support above the $6 psychological level. If it holds $6, it confirms that the recent breakout was real. If it breaks below $6, we might see a retest of $5.50. But look at the volume. The selling volume on this dip is relatively light compared to the buying volume we saw during the surge. This is a classic bull flag formation in the making. The weak hands are exiting because they see red. The strong hands are holding because they see the support levels holding firm. Now, I want you to challenge a common belief you might have. You might be thinking, if this company is so great, why is it losing money? It's a fair question. In Q3, they reported a net income of positive $2.5 million, but that was largely due to a non-cash gain from derivative revaluations, essentially financial engineering involving their warrants. On an operating basis, they are still burning cash. This is the common ground bears stand on. They say, look, the operations are losing money. But here's the contrarian take. You are looking at the wrong metric. In the early stages of a defense tech scaling phase, you don't look for net income, you look for backlog and book-to-bill ratios. You look at the stickiness of the customer. BigBear.ai's customers are the U.S. Army, the U.S. Navy, and Homeland Security. These customers don't churn. Once BigBear's AI is integrated into the workflow, once it becomes the brain assessing the battlefield or the logistics chain, it is incredibly difficult to rip out. The losses today are the cost of customer acquisition for contracts that will pay out for decades. Think about how you manage your own money. If you use Schwab Intelligent Portfolios or you're into self-investing via Fidelity, you know the importance of diversification. You probably have exposure to the mega caps like Apple stock or Tesla stock. But the role of a stock like BBAI in a portfolio is different. It's a call option on the future of warfare. We are moving into an era where wars are not just fought with tanks, but with algorithms. The Observe, Orient, Decide, Act loop, the OODA loop, is the holy grail of military strategy. BigBear.ai automates this. They take the massive ocean of data, satellite imagery, logistics flow, chatter, and synthesize it into a decision. Let's dig deeper into the Ask Sage acquisition because I cannot stress enough how pivotal this is. Ask Sage is a generative AI solution that is sovereign. In the commercial world, you might use ChatGPT or Claude, but the U.S. Army cannot upload classified troop movements to a public server. They need a walled garden AI. Ask Sage provides exactly that. It allows government users to ingest data securely and get generative insights without the risk of data leakage. By acquiring this, BigBear.ai leapfrogs the competition. They don't have to build this from scratch. They bought the solution that is already gaining traction. This creates immediate cross-selling opportunities. Every existing BigBear client is now a potential Ask Sage user. This is the land and expand strategy executed perfectly. I want you to take a moment and think about your own position. Comment below how many shares of BigBear.ai you currently hold, or if you are waiting for a specific entry price. Are you buying this dip at $6.17, or are you waiting for $5.50? I want to see where the sentiment is among the real investors. Now let's talk about the institutional landscape. When you look at the 13F filings, you see names like Vanguard Group and BlackRock Inc. holding significant stakes. Vanguard owns over 5% of the company. These aren't day traders on Robinhood flipping for pennies. These are massive asset managers who run Fidelity mutual funds and Fidelity ETFs. They are parking capital here because they see the long-term trend of defense modernization. Recently, we've seen increased activity. While retail investors on SoFi Invest might be panicking at the 1.5% drop today at 617, the institutional ownership suggests a buy-and-hold accumulation phase. They know that the government contracting cycle is slow, but once the money starts flowing, it flows like a river. We also need to address the Trump trade angle. With the political landscape shifting, there is a renewed focus on defense spending, specifically on modernization and efficiency. The proposed Department of Government Efficiency (DOGE) narratives we keep hearing about fit perfectly with what